Nothing in this recording is intended as investment advice, and the people in this recording may hold positions in the companies they talk about. Do not make any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to Zak's Traders Cafe. Today I'm joined by Michael Riedl, who's CEO, and William Green, or Billy Green, as he might like to be known, as his CFO at Team Internet. How are you today, gents?
Excellent. Thank you, Zach.
All right. I was talking about the old days with your predecessor, but these are different times now. You've released your audited 2024 annual report yesterday. What are the highlights for you?
Well, the highlight is certainly that in two of our three divisions we could demonstrate very respectable growth, basically in all facets: gross revenue, gross profit, and EBITDA. So in the domain business, which is like the stem cell of the business, which Ben Crawford, who you mentioned, and I had put together in a strategic transaction in 2018. Is in the best shape it has ever been, with near $20 million of EBITDA contribution and a very solid growth pattern. So gross revenue growing faster than the volumes, the gross profit is growing faster than the gross revenue, and EBITDA is growing even faster than gross profit, given that we are squaring the circle by enjoying record growth for this business. Definitely way above market growth for the business. And at the same time, we also managed to streamline operations, translating the success on sales also in success for our shareholders. Then with our comparison division, very similar pattern, more than 40% organic growth. And due to operating leverage, EBITDA went up by around 3/4 from 2023 to 2024. And what we do in comparison is basically the end game in online marketing, where nearly all of the income that you generate comes from commissions on actual sales, which is clearly where the market is developing towards. And so this is why we expect further success in this business. And then we have our third division, Search, which in this year goes through a year of strategic realignment, given some technology and process changes that our main partner Google is now introducing at a very ambitious timescale. And so what exactly happens here? What is the purpose of this business? The business is basically taking users off social media, understanding them, and then matching them with advertisers who have booked ads to be shown on Google. And this is what we have been doing in this business, and this is what we will be doing in this business. So here nothing changes. However, the process with which we make this happen is now undergoing a major renovation to make it more user-friendly, to make it more brand-friendly. And just in this year of transition, we must expect that our trading margin in between will be a bit compressed. This is the main reason for the reset of the forecasts in this business. Our long-term enthusiasm for this business is completely unchanged. So if you would have asked me before the recent announcement by Google to accelerate this transition materially, what my view of this business in 2030, if the answer would have been the same before and after, which is we expect this business to be a great business to be in, because the purpose will not go away. Walled gardens like Facebook and TikTok have captured trillions of screen hours, and we must help with our partner Google to bring these users back into the open web for the benefit of all.
Is it fair to say that Google has rather delivered a googly to you and to your business over recent months?
Well, the pace that Google is setting is clearly a challenge, or is the challenge, in the long run, we are fully with them that and appreciate that they're giving us a new tool with more future potential to operate this business in. The change of or the pace of the transition can raise some question marks. It's a bit like the EU Commission telling the car industry to pivot to electrical cars by the end of 2025. But we'll manage to get there. We will remain notably profitable at any point in time in this transition process. And let's not forget, we've taken control of this business only at the end of 2019, when the EBITDA run rate was around $10 million. Then it has taken us about 4 years to grow the revenue by a factor of 7, from $75 million revenue run rate at the time we took control of the business to roughly $500 million at its peak in 2023. Now we will see a bit of compression. However, we would still expect that at any point in time, the revenue run rate will be several times as high as it was in 2019 when we took the business over. So this is just now a volatility or a fluctuation around the positive long-term trend. And this is why already in our RNS, which we announced the reset of the forecast, we already promised double-digit growth rates again on a group level, but also on a division by division level as of 2026.
Right. So, I mean, you basically are absorbing, let's say, the odd headwind in the market, and in a way, one might say, given the lay of the land, you've actually done rather well, and that presents perhaps a value opportunity for people looking at your company now at, say, 60 pence a share, whereas a year ago it might have been 3 times that value. So, what would you say to people who sort of look at this as a value play? You're back, the shares are almost back to where they were in 2019, but obviously the metrics there have doubled and tripled in many respects.
Yes, that's right. So when the last time that I remember that the share price was as low as it is today, that must have been somewhere in mid 2019, still before we successfully expanded in online marketing, which then triggered some notable growth. And as I said before, the domain business, which we now report as a separate line, is in the best shape it has ever been. And if that business alone was worth 60 pence back in 2019, then the sum of that business plus our comparison business, which is in a fantastic shape and is still a very profitable search business, should be worth more than that. And in order to help the market in the discovery process, we have pivoted to a more granular divisional or segmental reporting, now dividing between domains, identity, and software, which is our old core business. The comparison division being our youngest business, which is now under control since about 3 years. And then the search business, which we've built over the last 5 years, where we give all key P&L items just down to EBITDA, so that the market can do its own value discovery by identifying the right multipliers for each component part of our group EBITDA.
Just moving along to Billy, obviously this is a sprawling business and there are lots of moving parts, but maybe in terms of the key metrics like adjusted EBITDA and your cash flow, there's actually still, even within what's happened in the last 6 months or a year, some decent figures in there.
Well, even in a year when earnings are lower than the previous year, it's important to us that we keep generating cash. So the growth in cash generated year on year was more than just a consolation for the earnings change. And even this year, when again headwinds continue to hit the search segment, but comparison and the domains business both grow, I still expect each division to be heavily cash positive individually. So the combination of those three is hopefully still irresistible for us as a group that is able to generate cash and either use that cash either to delever or to return cash to shareholders.
And do you think that there would be quite a decent sort of snapback in these figures next time, maybe this time next year, in the sense that there will be, you'll be flattered by the downturn that you've had now?
Well, we've now got a revised consensus in the market, which we're confident of meeting. So for this year, for next year, the market now understands what the expectation is. Naturally, we hope that as we work through the evolution of the search business, we'll be in a position where we can not only meet but exceed that outlook. And I'm confident that we'll be looking back at this year as the lowest earnings level, and we'll continue the growth path that we pursued successfully over the last several years, with effectively a bump in 2020, 2024 into 25.
And I mean, just as a general question, would you say that this is something you would typically see in a company which is rapidly expanding, and it's nothing to be sort of wary of?
It's hard to generalize in terms of specific examples of companies that have been through exactly what we're going through. Although we do have competitors and peers that are going through a similar pivot, evolution in strategy and product. I have worked in other businesses myself where you have a temporary negative impact on earnings because of a change in a product, but as long as you're able to compete effectively and to use the new product to its highest potential, then you come through that. It's very helpful to us that while the search division is going through that, the other two divisions of the business, both domains and comparison, are both absolutely flying. They're in the best shape they've ever been in, both other parts of the business. So I think if we were as concentrated on one product or one segment as we were 2 or 3 years ago, then this transition would be more painful for us as a group. As a reasonably diversified group, we have lots that's positive to talk about, and the search division has got the funding, the support, the time it needs to get its competitive nature into the right shape, which is already starting to unfold nicely, and will continue through the rest of this year.
Michael Riedl, CEO, and William Green, CFO, thank you very much. And we will hopefully speak again to Team Internet.
Thank you, Zach.